Mr. Mark Selby. How are you, sir?
Very good, Mr. Matthew Gordon.
Well, it's a shame we're not seeing you face to face and having dinner like we did when we were in London, but I'll take what I can get. That said, be seeing you down in Durban in a week or so, just over a week, isn't it?
Yes, yep, Cape Town.
Cape Town, yeah.
Yeah, the one-to-one shows. We've got a lot of fund managers from Australia and a lot of fund managers from Europe, so it's a pretty productive couple of days. We actually get a bunch of good meetings in. So
I was going to ask you, because obviously you're not an African project, not that I've noticed, but a lot of the fund managers are from Australia and Europe come down to that one as a kind of central meeting place. Okay, so okay.
Yeah. So it's
nice.
In terms of junior mining scale conferences, I would say it's one of the top 2 or 3 in terms of being able to really connect with good investors, and in terms of some good networking, because there's a lot of people around that even if you don't have a formal meeting, you can bump into a pile of people and get some decent work done, which is
nice. Good. Okay, good. And it's obviously it's had to move till May, so the weather's not quite as nice, but we're there to work, aren't we, Mark? We're there to work. He said, smiling. Right. Okay. We're going to talk about world of nickel as usual, as we do.
Yeah.
But I want to go somewhere else first. Okay.
Okay.
Market is just that little bit weird at the moment. I've had lots of people come up with lots of theories about what's going on, what people are thinking, how things are going to behave. So I want to do this in the context of the fact that nickel prices haven't dropped, right? Nickel prices haven't dropped.
Yeah.
However, equities have, not just nickel. I'm talking everything. Junior mining equities gone through the floor. So the question is, why the disconnect? What are you seeing out there? What are you putting it down to?
Yeah, no, fundamentally, there's a very long, multi-decade, if you're a hedge fund manager, it kind of goes like this, interest rates go up, US dollar goes up, US dollar commodity prices go down, and mining equities go down even further. So, as soon as you saw some real conviction from the central bankers and comments from the Fed chair that they're going to do maybe 75 basis points in the next interest rate rise. For a lot of hedge fund managers, that's just hit the big sell button and just get out, and we'll see where this thing bottoms out, and we'll come back. We'll come back in a bit. What's interesting though in that chain is we really haven't seen commodity prices come off at this point, which is surprising. I think it's a function of the fundamentals are so strong and the market is so tight right now that it's really tough for them to get there. Now, at the first sign of any real weakness, you are going to see fundamental weakness in any of the commodity prices. The commodity prices will work to catch up with the equities, but I think that's going to be the key question as the year goes on.
Well, it's a few things you raised. Like if you look at base metals, they don't seem to be behaving quite the same way, though. Are they the exception?
Right. Oh no, they've none. Everything's in great shape. Copper's come off maybe 4 or 5%, but it's still 10% higher than it was a year ago. So the commodities have totally, everything else has fallen into place, but commodities have completely disconnected from that chain. And again, it's one of these disconnects that creates some investing opportunities. So again, if I go back to where I was 3 or 4 months ago, I don't think the story has changed in terms of battery metals. And I think this is going to be, sort of a two-step kind of potentially slow down recession. In 2001, back with the last sort of significant recession we had, global financial crisis notwithstanding, but in terms of a traditional recession, what was interesting is if you look back prior to that, you typically kind of came down, stayed down for good 18 months, and then you kind of sort of came back up again. What was interesting with that in 2001 was despite, again, we had inflation was in the probably what were records we're breaking now or back into that kind of a time period. Inflation was relatively high. We had just come off the dot-com bubble, so equity valuations were really, really frothy. Again, not different than where we are now. And from a recession perspective, in the metal markets, is a really relatively short, sharp recession. And what it was is, you had China continuing to grow at a relatively robust pace, whereas the rest of the world went through a more traditional recession. But China had got big enough that it kind of dented the just how long that recession was. And I think what we might be seeing now, again, this is just early days thinking wise, but is we're going to see, we're going to see battery metals and everybody else. So everybody else, I think, will go through a more traditional kind of a recession slowdown. But the battery metals, given the strength in that sector, I think, we'll have some things will slow down, won't grow quite as quickly, but I think it'll be interesting to see where you have this sort of two-step kind of market.
See, I can understand why retail are getting confused, because there's a lot of mixed. Even what you've described is a kind of mixed messages. Some of it will be fine, some of it won't, right? And what I've got to ask is, will it actually be a full-blown recession? Because you've got economists on one side arguing that it will be, the bubble's about to burst. Lots of bubbles will burst. And you got guys on the other side saying, well, don't worry, it's just, slower growth. Don't worry about it. It'll be managed. The politicians won't do anything stupid this time. It'll just be slower growth. And I kind of question that. I can sort of see why people are hoarding cash. I can see why people perhaps have less disposable income and therefore less discretionary spend on things like investing, because they can't read the market like they could in 2020, like they could in 2021, where it was kind of easy to get things right. Yeah. I think it's going to be very easy to get a lot wrong now, because the variables seem slightly out of whack, slightly out of control, and they're not following the usual rules. So I can see why people are confused, concerned, and behaving like they are. But here's the thing. What effect is that going to have on some of these junior mining equities? Because I don't know if you remember, sort of 2012 through to 2014, we saw this happen then. Slightly different reasons, okay? But the behavior was the same, which forced a lot of these brokers to actually, certainly here in the UK, Europe, to schlep back home to North America. And the knock-on effect for junior mining equities was they couldn't get the money that they needed to advance these, small early exploration stories. These, or even the advanced exploration stories, were struggling to get cash. That had a big impact, and caused a kind of gap in the supply chain, as it were, in terms of the producers weren't going to get the sort of big wins, the big finds that they could go and then purchase further down the line. So I think that was one thing. Like I said, it's for slightly different reasons, but the behavior of investors was the same. I mean, I don't know if you remember that far back, or how you were affected, or where you were at the time. Yeah, but what do you think?
Oh no, as a person running a junior in 2012, 2014, that was a very painful time. And not only did those brokers pull out of Europe and go back to North America, they completely disappeared out of existence in North America as well. I think what's different here. So I think if we contrast the two periods of 2007, 8, 9, and then the 2011 to 2013 slowdown. The 2011 to 2013 slowdown. A couple things. One, again, it was the global economy slowed down. And so, that caused, again, sort of the typical chain to happen. But we had just come off this huge, splurge of spending by all the majors, who finally, after a decade of growth in China, got around to actually building a bunch of projects, all at the same time. They went way over budget, and it was basically, okay, we're not doing big projects anymore. And the whole mining development cycle, really ground to a halt. So in that case, you had a mining development cycle come to an end and an economic slowdown happen at the same time. And that was where you went through, the 3-year march through the Sahara Desert, trying desperately to find some cash to keep your projects going. I think this is going to be more like that 2007 to 2009-10 period where, again, what we went through in the global financial crisis and the whole economic smack in the head was far more severe than we went through in the 2011-13 time period. But what hadn't happened is, again, China was continuing to grow really, really strongly. The industry was behind the curve in terms of supplying China with the raw materials that it needed. That big sharp slowdown basically, made that gap even further. So when we came out of that recession, if you look at 2008 to 2011, it was just, it was even more face-rippingly positive than what we saw in the first part of that cycle. So again, given that we've come off, that 2012 to 13, 14 almost lasted most of last decade for a lot of commodities, we've come off a prolonged period of underinvestment. And so we need that. I was at a benchmark minerals conference in Toronto yesterday, and it was again across so many commodities. If we really want to achieve the kind of electric vehicle goals we need, there's a huge amount of investment that's needed in raw material capacity. So I think we'll come out of this still needing that raw material capacity to come to market. Again, from an investment perspective, these slowdowns do kind of help separate the wheat from the chaff. So, make sure, if you've got cash in the market, to keep it into higher quality names, even more so right now. But once we get out of this, again, the 2025 EV sales and the 2030 EV sales, aren't going away. So we need to find the raw materials to supply them.
I think that's right, and I want to make the case because I don't want to scare people here, but in the sense my comparisons back to the 2012 to 2014 period, it's similar in the sense that the money disappeared, both institutional and retail. Right here. The institutional money is still there. It's still there, right? It's easy, or it's not so difficult for companies to go and raise capital in this market because the institutions are looking forward to 2025 to 2030 numbers in the case of battery metals, and going, yep, the demand's definitely there. We're all good. The infrastructure that's being built out says that these companies will do just fine. Retail is the bit that I'm getting at, and retail is important in the sense that the confidence isn't there because they don't look to 2025, 2030 numbers. They look at, how do I make a return this year now? I've got it, I've got my own set of problems and drivers for that, right? Which takes the liquidity out of the market. And we've seen that, I think, the last 2-3 weeks where that confidence isn't there. And therefore that liquidity and that trading, which is the thing which kind of drives the share price movement, isn't there anymore. And and I would say to people, this is the old, you've got to have some degree of confidence in your thesis and kind of stick with your thesis. And if you want to try to trade the ups and downs, and that's all good. It's all part of the wonderful mix that we have of investors out there. But for me, this is not quite as good as March 2020 buying opportunity, but I've definitely been taking advantage of it the last 2 weeks because there's some great prices out there at the moment. And I think if you're smart, you will have been doing some of that.
Oh, 100%. And I think, the other thing to realize is, there are a lot of funds that, are long short. So they're taking advantage of this macro weakness to go into names that are relatively liquid and see just how far they can drive them down, because they know they can get some retail guys to capitulate, and then they'll start hoovering stock up, at a lower price. So that, there's guys who still love a story, but, again, they're just going to take advantage of this to try and drive prices down 15 to 20%, reload and take it back up again. So again, if you want to try and trade against those guys, great, but, just be careful. But, to your point, if you've got fundamental belief, this is one of those buying opportunities. I'm not sure it's quite as good as March 2020, but it's still
I agree.
A good spot. So.
Yeah, that was for me, once in a lifetime moment. But this is running at a pretty close second. Right, we better talk nickel. That's what people are here to listen to. So, what's happening with nickel price today? What's driving it?
Oh, it's been remarkably boring. After the fireworks of 6 weeks ago, I expected a lot of aftershocks. But if you look at the nickel price chart, it did this. And then it's been, relatively, either side of $15 a pound during that time frame. Nickel inventories have stayed relatively flat. What's interesting when you see the other commodities, you've got zinc and aluminum continuing to tick down. Copper inventories are going up. Again, you get a lot of copper analysts get really super bullish on copper, but with inventories going up and TCRCs going up, we'll see what happens there. But nickel in good shape in the physical markets as well too. The same sort of we're seeing the gap. So prices didn't necessarily rise up to where the LME was, but they've been slowly grinding higher. And what you're seeing in the consumer chain is basically buying what they need, but not really stocking up at these prices. And given the amount of volatility that's happened, so again, a lot of prices. There's been some interim volatility, but generally stainless and a lot of the other prices have stayed relatively flat. Sulfate prices in China are still trading at a discount to the LME, so we'll see how long that holds up. But the key thing is the Chinese SHFE prices have been going up towards the LME price, and if they get higher, then we'll start to see imports flowing in again. And so, I think that'll be a key point, is to see whether that emerges and or what LME price, SHFE price, those things come out. So, but yeah, so far on the physical front, nothing, in terms of alarm bells to think that we're going to start to see prices come off anytime soon.
Right, and before we kind of get into things like the INSG forecast, etc., I want to come back to a phrase you use, which is buying on a needs basis. We've seen companies having to move from just-in-time buying, in terms of equipment and so forth, because the supply chains were so buggered that they couldn't get stuff, and that but for the want of a nail, the war was lost sort of scenario, where additive filters was causing operations to shut to shut down, or at least run at significantly less than optimum rate. So with the commodities buying, whether it be nickel or copper or whatever, we've seen a few different kind of thoughts here, but the price obviously has been so volatile at the moment that people weren't quite sure where this whole thing was going, and inventory levels were building up and then dropping off, and it's been very erratic. So do you think we'll now get back to where we were, either kind of pre-price rise mentality in terms of the buying and inventory levels, or pre-COVID levels? It seems so long ago. Are people kind of a little bit calmer about these demand numbers which are coming down the line?
Yeah, I think it'll still take several more months. Again, I think if we weren't having this overhang of interest rates rising and all this talk about recessions, that's the kind of thing. Again, in that environment, people tend to pull back in terms of, okay, I'm only going to buy what I need, just because I'm not sure what's happening with this sort of macro economy overhang as well. So, but I think in the metal space, that this will continue sort of on a buy as you need basis for another 3 or 4 months or more, until again it really emerges. Okay, are we just going to have a slowdown? Are we going to have a recession in terms of the macro, in terms of the nickel aftershocks? Again, if prices, both the SHFE and LME and all of the other downstream prices, get to a point where, quote, people see them as normal again, then they're going to start to be more confident to start to step in. So again, I think it's another 2 or 3 months of this, and then we kind of see where we go from there.
I always just insert the word toilet paper or pasta.
Exactly.
And it gives you some sort of sense of how people think about buying. It's a truth. Bring it back to everyday things, and it's easier to understand. Right. I mentioned INSG forecast. So what are they telling us?
Yeah. So what's interesting, again, this is a collection. INSG is a collection of government representatives, who come up and with some full-time staff who come up with forecasts, and they do a good job in terms of managing all the historical reporting. Forecasting, because of the nature of the organization, has to be on a effectively consensus basis, and consensus is never going to really ever capture sort of the extreme swings one way or the other. But I think nickel investors should take some confidence that they see demand up 8%, more than 8%, up to over 3 million tons in 2022. I think we'll get to a double-digit growth number this year, either probably undercounting that underlying EV demand coming through. They see nickel output rising up to a point with just over 3.1 million tons. So they've got a surplus of about 60,000 tons. the real structural problem with the INSG forecasts, and I used to complain vociferously when I was back at a nickel company, is they don't have any disruption allowance. So most analysts add up all their supply forecasts and say, look, we don't know who's going to have an issue, but we know some people are going to have issues, and we take a couple percent off of that number. And so and generally that can range anywhere from 2 to 6% in a year. So, the fact that they've got a surplus, right now, I think is effectively a balanced market, from looking at INSG numbers, looking at INSG numbers, I'm happy that that's where the year started. And to me, this is a bullish outlook for the rest of the year, because again, I think demand is going to be higher and supply is going to be lower. And, we've seen the Q1 numbers come out already. For a lot of majors last year, 2021 was a horrible number, a horrible year. People were talking about, it was so bad in 2021, the production will have to be up in 2022. There's no way they can do it. But we've already seen some of the companies reporting Vale nickel production was down in Q1. BHP, not only was it down, they ended up already, 3 months into the year, lowering their forecast for 2022, knocking it down by 5,000 tons. But again, that's a 6% drop. And Anglo as well was down something like 8%, year over year in the first quarter. So again, Western supply, it's been underinvested, for a long time, and that just leaves it susceptible to all kinds of supply chain shocks. And as you're talking about, we lost production because we couldn't get filters. It's those kinds of issues, that are really having a constraint on supply. So again, fundamentally, Q1, I think the market's in decent shape. We're just going to have to see sort of how this recession talk, plays out in the physical markets.
My immediate question, when you talk about Western supply being a big issue, Vale down, BHP down, Anglo down. They've got to do something. There's got to be a reaction to that. So, before they do that, I've got to understand why. Was it entirely due to supply chain issues because of COVID or knock-on effects from whatever they want to put it down to, but they would expect 2023 to improve? Or are they getting nervous and saying, well, this is what the future looks like, guys. Maybe we need to kind of step up, make some acquisitions, or at least start the process of looking at making acquisitions to kind of backfill our resource and reserve numbers. What do you think they do?
Oh, for sure. I mean, with prices still at relatively high levels, these guys are generating massive amounts of cash. And so, again, 10 years ago, they blew their brains out on bad projects. Investors said, don't do big projects anymore. So they stopped doing that. We want you to actually generate some cash. And so that was the real focus for most of the prior decade. They've been pretty good about returning capital over the last 2 or 3 years. And now I think the investor push is really around, okay, that's great. But, when we invest in companies in other industries, they actually grow. That's kind of what we would like to see happen. So I think that, that sort of emphasis on growth and you need to get active and start to have a growth pipeline again. That's not going to go away anytime soon. That's going to be a fundamental part of this coming decade.
There you go. Well, Mike, we'll leave it there. You got places to be, phone calls to make. I will see you probably next Sunday in Cape Town. So have a chat.
That sounds great, sir.
At the very least, a drink. Okay. It should be a good one. I'm looking forward to meeting some of these fund managers and some of these institutions and hearing from them what they're interested in, what's making them nervous, because that gives us an idea as to how we should invest. See you next week.
Have a good week, sir. Take care.